Welcome to The Explainer. Today, we're unpacking the fascinating blueprint of literally one of the greatest self-made stock pickers in the history of finance, Peter Lynch. We're going to look closely at how a really unique philosophy, born out of personal tragedy and just regular hands-on observation, allowed him to see what Wall Street completely missed. Okay, let's dive right into this because 29.2% is an absolutely staggering number. I mean, that is the average annual return Peter Lynch generated over a 13-year period while running the Fidelity Magellan Fund. To put that into perspective for you, he consistently trounced the market for over a decade. But how did he actually achieve such an unprecedented track record? Well, to understand his investing genius, we actually have to look far beyond Wall Street. Section 1. From Caddy to College, Building a Foundation. The foundation of Peter Lynch's legendary work ethic actually stems from a deeply tragic early life event. When Lynch was just 10 years old, his father, who was a successful accountant providing a very comfortable lifestyle for the family, passed away from cancer at the really young age of 46. This forced his mother to take on two jobs. So, determined to ensure she wouldn't have to work forever, an 11-year-old Peter took a job as a golf caddy. But, this wasn't just any job. It was his introduction to networking. He became the absolute hardest working caddy on the course. One day, a Fidelity executive named George Sullivan misplaced his umbrella. Young Peter actually used his own money to buy a replacement for him. That simple, selfless act left a massive impression, and it ultimately helped Lynch earn a full caddy scholarship to Boston College. Now, you might expect a future financial titan to spend his college years buried in spreadsheets, right? But Lynch defied normal business preparation entirely. Instead of loading up on economics, mathematics, and accounting like your typical Wall Street hopefuls, he focused on the humanities. He studied metaphysics, logic, psychology, and history. Why? Well, because Lynch believed that finance at its absolute core is about people. To understand markets, you have to understand human behavior. Section 2. Chasing 10-baggers. First, major wins. Now, what's really interesting about this is, to understand his strategy, we have to look at a specific vocabulary term he popularized. The 10-bagger. Borrowed from the game of baseball, a 10-bagger is a stock where you make 10 times your original investment. In Lynch's mind, a small win, or a 4-bagger, is nice, but it isn't going to transform a portfolio. He was persistently on the hunt for massive, scalable growth companies that the rest of Wall Street just hadn't noticed yet. And he found his first major win with a company called Flying Tigers, which was the first cargo airline in the U.S. Lynch recognized early on that aerial commercial shipping was just going to explode, so he poured his savings into it. For 3 years, the stock completely stagnated. But Lynch had learned patience on the golf course. Suddenly, the Vietnam War escalated, and the unexpected demand for shipping sent the stock skyrocketing. By 1965, his $1,250 investment swelled to over $6,000. That was enough to pay his way entirely through grad school at Wharton. But hey, he wasn't immune to failure. Eventually, the Vietnam War required more recruits, and Lynch was stationed in South Korea. Far away from American companies, he tried to replicate his Flying Tigers success. He found a company called Maine Sugar Industries. On paper, it was brilliant. They had this plan to convince potato farmers to grow sugar beets during the off-season. Thinking he'd found another secret 10-bagger, he literally called his brokers from Korea and bought as many shares as he could. So what was the trap? Well, the trap was distance investing. Because he was halfway across the world, he couldn't do the physical legwork. If he had, he would have seen that farmers are naturally risk-averse, and they simply weren't planting the sugar beets at full capacity. The brilliant theory failed in reality. And from this, Lynch forged an ironclad rule that really applies to all of us. Never buy a stock without conducting on-site investigation. Always check with customers, suppliers, and competitors first. Section 3. Rising at Fidelity, Vacuum for Leadership. So Lynch returns from Korea in 1969 and joins Fidelity as a research analyst, right in time for an economic recession. And Fidelity was in a really desperate state. They had lost their star technical trader, Jerry Tai, and with him went a massive number of loyal clients. Plus, they had suffered a 1969 insider trading scandal. At one point, the firm lost a staggering 1/3 of its total assets in a single year. It was a pretty dark time for the company, but it created the perfect vacuum for a totally new kind of leader. While the stock market collapsed all around them, Lynch's personal stock recommendations as an analyst were absolutely thriving. By 1974, he was promoted to head of the Magellan Fund. Instead of running from the bear market, he treated it as an absolute bargain bin. He viewed investing almost like a game of stud poker. If he found 10 good stories, he bought all 10 and just waited to see the cards turn over. He bought so many diverse potential 10-baggers that the law of probability worked in his favor, earning him this famous reputation as the man who never saw a stock he didn't like. Section 4. Art of Stock Picking, Immersing in Business. This brings us right back to his college days. Lynch's financial strategy was deeply rooted in empiricism. This is the philosophical concept that prioritizes learning from direct, hands-on experience rather than purely theoretical knowledge. He didn't just read numbers on a page. He immersed himself in the businesses he wanted to buy. If he liked the product and others loved the product and the management seemed solid, well, that was his evidence. And this brilliantly illustrates the huge divide between his approach and the rest of the financial sector. While professional Wall Street investors were obsessing over expensive software like Bridge, Shark, or Bloomberg terminals, Lynch believed that a pile of software wasn't worth a dime if you didn't do basic, human-driven homework. His tools were visiting local stores, checking inventory, and literally just hanging out at the mall to see where regular people were actually spending their money. A perfect example of this is the Taco Bell trade. On a trip to California, Lynch simply ate a burrito at a local Mexican chain and was incredibly impressed. Using his empiricism, he investigated further and found they had zero debt and hadn't closed a single restaurant. He started buying shares at $7. Less than a year later, PepsiCo acquires Taco Bell at $50 a share. His simple enjoyment of a good lunch, combined with basic legwork, resulted in a massive, rapid profit. Section 5. Costly mistakes, learning from failure. Even the greats make mistakes, right? Lynch had a local favorite in Boston, a gourmet sandwich shop called J. Bildurner, located right across from his office. He loved their bread, loved their sandwiches, and when they went public in 1986, he eagerly bought in at $13 a share, assuming the whole country would love it too. But he forgot to ask one absolutely crucial question. Does the idea work in some other place? The answer, unfortunately, was no way. What worked as a prototype for middle-class white-collar workers in Boston failed completely when trying to compete with established delis in Manhattan. By the time they tried to expand to Atlanta, they were completely out of cash. Lynch learned a painful lesson about the scalability rule and had to unload his shares at staggering losses ranging from 50 to 95%. The takeaway here? Just because a local business model is fantastic doesn't mean it will survive in a new market. Section 6. Knowing when to quit. The final chapter. So, the crucial point in this chapter comes down to the age of 48. In 1990, at the absolute height of his fame as the most celebrated investor on Wall Street, Peter Lynch completely shocked the financial world by retiring. Why? Because he remembered his father, who had died at age 46. Lynch had worked relentlessly to provide for his family, sometimes at the expense of seeing his own children. At 48, he realized no amount of money could buy back time. But, there was also a structural mathematical reason for walking away. When Lynch started having his best years in the early 1980s, the Magellan Fund had under $1 billion in assets. It was agile. He could easily swoop in on small 10-baggers. But by 1989, his own success had bloated the fund to $17 billion. At that gargantuan size, it became incredibly difficult to scale and find new 10-baggers that could meaningfully move the needle. He retired right as the fund reached the absolute limits of its historical agility. Now, years into his retirement, a ghost from the industry did resurface. In 2008, the SEC charged Fidelity for receiving millions in corporate bribery, which included VIP tickets to the Super Bowl and strip clubs. Peter Lynch was swept up in these charges as well, ultimately paying a $20,000 fine for receiving tickets to Broadway shows and golf tournaments. As the data shows, while Fidelity faced massive scrutiny from millions in improper gifts, Lynch's specific penalty was relatively minor and tied strictly to event tickets, something that ultimately did not unravel his historical legacy as a fund manager. Which leaves us with this final thought. We look at the 29.2% returns, the brilliant empiricism, and the incredible instinct for finding hidden value in everyday life. But perhaps the most profound takeaway from Peter Lynch isn't a stock tip at all. Does immense wealth justify sacrificing time with the people you love, or was recognizing his limits and retiring at the absolute peak his greatest trait of all? Think about that next time you're evaluating your own definitions of success. Thanks for learning with us today.